Good afternoon and welcome to this FBF online seminar. My name is Pierre Schlosser. I'm the scientific coordinator of the Florence School of Banking and Finance, and it is a pleasure for me, even in this very particular times, to welcome you all to today's online seminar on Bank-Fintech collaboration. I'm very glad to welcome our lead speakers of today, Professor Luca Enriques from Oxford University and Professor Georg Ringe from Hamburg University, and to welcome our commentator of today, Anna Maria Nowak from the European University Institute. I will not guide you through their biographies as they are available on our website. Today we'll be taking a break from our online series on the coronavirus, but I think that there is great value, intellectual value, maybe also psychological value, in speaking about another type of disruption to the financial system. Fintech actors have been mushrooming over the past years at high speed and are challenging the relationship between banks and their customers, but also in between financial actors themselves, as we'll hear today. In this context, it's legitimate to ask how much cooperation and how much competition the post-crisis financial system will bring to bear among its actors. Now, before entering into this really captivating discussion of today, I'd like to inform you about our school's upcoming activities in 4 or 5 minutes, really. You may know by now that the Florence School of Banking and Finance, FBF in short, is a non-national training platform, which is part of the European University Institute. The European University Institute, EUI, is a very distinctive place. It's a public intergovernmental research and education institute which boasts an international community of more than 60 nationalities and offers both doctoral and postdoctoral as well as executive education programs in economics, law, political science and history. As of September, it will also offer 2 years Master of Arts in Transnational Governance. The Florence School of Banking and Finance is a quite recent program of the EUI. It is a place where various generations meet to discuss and argue about cutting-edge topics of financial stability, risk management, as well as regulation, supervision, and resolution. Our school has a diversity of policy debate and training activities, both residentially and, as you can see, online. You can find more details on all our activities on our website and on LinkedIn, but for now, let me just flag a few of them which could be of interest to you. First, I'd like to inform you of the launch of our online course on the regulation and practice of securitization. The course will be held from the 8th to the 22nd of May. The online course faculty is made up of both academics and senior industry practitioners, as well as senior policymakers, and it will provide you with a solid overview of the regulatory and practical dimensions of securitization. It will close up also with a module on green securitization that will bring you very close to the frontier in the field. There are still a few seats left and available, so do not miss this learning opportunity. Also, we're literally these very days working on 3 other types of activities. The first one is DebtCon 4. DebtCon 4 is a major global and interdisciplinary conference on sovereign debt with call for papers. It will be held at the UI in Florence on 7 to 8 of September, and it's done in partnership with Georgetown University and the Graduate Institute of Geneva. The second line of activities are online, is our autumn residential courses, which will focus on fintech, digital currencies, bank resolution, and climate risks, amongst others. The third event is an online seminar led by the European Commission, the DG Comp, as you say, on the temporary framework for state aid. It will be held this very Friday, so do not forget to sign up if you're interested. Lastly, I'd like to mention to you that in these times of epidemics, you may consider having a look at our previous ebooks, as well as the recordings of our past online seminars, which are, for your reference, all available on our website for free. So feel free to have a look. Okay, so I think it's time to introduce you to each other. We are on the platform today a bit more than 110 participants connected, following us from everywhere in Europe and also beyond Europe. There are 51 nationalities represented. We have quite a good mix of public and private actors in the room today. You come from a variety of backgrounds. Then we have also, in terms of gender, 42% of you are women, 58% are men. You have about 9 years of professional experience on average. We have a majority in the room, not a big surprise, today of lawyers by background. We have 44% of lawyers, 37% of you are trained economists. Lastly, 67% of you have a master's degree, while 26% of you have a PhD and 7% have a bachelor degree. So we will now start literally. Just to guide you a bit further, how will our seminar be structured? Well, Georg and then Luca will speak for about 25 to 30 minutes. Their talk will be punctuated by 5 interactive polls. Anna Maria will then step in to share her comments for about 7-8 minutes. And following all this, we'll open up the Q&A session where you participants will have a chance to simply type and write your questions or comments actually in the chat box that will appear at the bottom of your screen. The chat box is not visible right now, but it will appear once we change environment at the very end of Anna Maria's comments. I'd like at this stage also to thank my colleague Jan, who has supported the preparation of the seminar and who is managing right now our online platform as we speak. So without no further ado, I'll leave the floor now to Georg and to Luca, who I think were on the platform already. So I would just ask Georg and Luca to share share your camera and microphones. These are 2 different steps on this platform, and activate your microphone, and the floor will be yours in just a second. Thank you again for being with us today.
Thank you very much, Pierre. It's a great pleasure to be here and to share a little bit our research that we've been doing over the past several months. So this project, as you've already been saying, is looking at collaboration between banks and fintechs and outsourcing arrangements. And we are making a policy proposal towards the end, which we call a fintech mentorship regime. And we try to make our case for why this regime is a helpful addition to the current status quo. Just to set the stage, this is a work in progress. This is an ongoing research project. We're extremely helpful and grateful for any feedback that you have, and this will help us to to further develop this project. Any view from the practice is particularly welcome. Thanks so much. So let me start by motivating this and giving you a little bit the snapshot of this project. The idea comes into the background of a number of attempts to regulate an effective fintech ecosystem. I think an idea that is popular around the globe, not least since the coronavirus, but already long ago, regulators worldwide have tried to find ways of making a good and viable and effective ecosystem for financial technology. And there are many things on the screen, but one thing that we in this project have been looking at is the collaboration, the partnership idea between fintechs and established banks. And that is something that we're seeing frequently. They've become partners, right? They provide startup with access to know-how, to reputation, access to markets, and banks will also help fintechs to overcome with regulation, with regulatory barriers, and that's the main focus of today's talk. So in that case, we're making the case for our mentorship idea, the optional regime that we would propose allows fintechs to operate under a bank license. Now, I think we have a question to pose. Jan, would you like to put it up? Yeah, so the question to everybody would be, what do you think, how serious are the regulatory barriers to entry for fintech startups between 1 and 5? I'll just give you a second to see what the feeling is. Okay, so there seems to be a view that regulatory barriers are quite an obstacle in getting into the market. And that somehow chimes well with our perception of the startup situation. Now, let me move on and explain a little bit the background. The original fear a couple of years ago when financial technology was coming for the first time was fintech will be disrupting. The original fear, I'm saying, or the original hope, depending on which side you're on. Fintech will disrupt the established players and there will not be any traditional banks in the future anymore. And obviously that is not what is happening, right? We're seeing that both sides are realizing that they can profit and benefit much more by collaborating and by interacting together. And there are many good reasons of why this is happening. Yeah, so fintechs immediately get access to troves of data from the established banks and can use them in a much better way, maybe. There is a knowledge transfer idea between them from both sides, actually working for both sides. Many have their advantages on both sides. There are obviously economies of scale and synergies. There are marketing advantages where the bank has a big, a good reputation that it can lend to the fintech. Similarly, reputational spillovers. And finally, and importantly here for us, there may be possibility of having regulatory access using the bank of getting into the market and overcoming those regulation problems that we identified just a second ago. Now, how does these collaborations work at the moment? So this is looking at what is happening already right now. There are already 3 different forms of cooperation, and you can classify and categorize them in different ways, but this is just one way of doing it. One important caveat is that most of these things happen through technology, through APIs, these interfaces. So banks can already integrate financial technology through technology in some way. And one form of doing it is called white label banking, or you can say banking as a service, where the fintech operation is integrated into banking services. And to the outside world, the fintechs is de facto looking as if it's an independent player and using the full package of banking services to attract its customers. So if you are a little customer and you open an account, quote unquote, with a fintech, then actually in reality what you might do is you have a bank which is operating behind the fintech. And you as a customer, you don't realize that unless you scroll down to the bottom of the screen where you read in the small print that in fact the fintech is partnering with or is powered by bank so and so. So to the outside world, the bank doesn't really appear. And the second solution is basically the other way around. You can call it white label fintech or software as a service, where to the outside world it's only the bank that is appearing, and the bank is operating and transacting with customers, but indirectly it uses financial technology that it gets from its partnering fintech. So the bank uses financial technology from the outside world to improve its own portfolio of services that it can offer, but to the customer, it's only the bank that appears. And the third category are joint ventures and co-branding partnerships, which are not the main focus of today's talk. But options 1 or 2, important to understand the difference. And you can also, there's another way of categorizing them. So you can say that one could be a full stack neobank, where the IT engine de facto remains in the holding. And that would be similar to the white label fintech. Whereas the front-end neobank is de facto the fintech itself is having all the software and does all the business itself. Now, I give you 2 case studies to make this a little bit clearer. N26 is a major and well-known fintech. Well, it's not anymore really a fintech because it's already now quite established. But it was very, as every startup, it was junior a couple of years ago, and it partnered with a major bank, at the time Wirecard Bank, when it was junior, and it used Wirecard's banking license to get into the market. Sometime later in 2016, N26 received its own banking license, which allowed it to be a little bit more flexible and freer in its decision-making part. So it's now become a major bank itself, and now the interesting point is N26 is partnering itself with new smaller fintechs and helps them to get into the market. So it is a full stack neobank. It is in the categories that I've described before, a white label fintech or a software as a service, because to the outside world, N26 is transacting with customers and it uses a lot of fintechs now to partner with, but they don't really appear to the outside world. They are increasing the product range of N26. They are giving them a cutting edge maybe in terms of technology, but they integrated into the N26 business. Interestingly, just a little add-on to this, just now as we speak, N26 is entering the American market, and there it's using its original plan, right? So it's partnering with a major bank to get into the American business at the moment, and who knows, maybe in a couple of years from now it will change that too. Now the other case study is a bank, Solaris Bank. Maybe we should ask a poll how many people have heard of Solaris Bank, but it wouldn't be surprising if the number is quite low, because this is an example of a bank that does not appear itself frequently to its customers. Solaris Bank is nothing else than a service provider which has a full banking license, but the sole purpose of this bank is to partner with new startups and to grant them market access against something, against a fee typically, or against another consideration that the fintech has to pay for using the banking license of Solaris Bank. And these fintechs, then you have a list here on the screen, these fintechs are then able to operate themselves and attracting customers and doing everything themselves. So this would be an example of a white label bank where the bank itself doesn't have a lot of customer contact, but is basically just giving a helping hand to the fintech to get into the market at first. Now, how does that all look from a legal perspective? This goes under the heading of outsourcing, because there are a number of outsourcing relationships here. What we're seeing is different relationships. We see situations where the fintech includes banking services in the client package, but outsources the provision to a bank. And the other way around, where the bank outsources distribution of its services to a payment services or another fintech provider. So it may be confusing to ask, who is here the outsourcer and who is the outsourcee? Well, the legal regime is actually quite clear. It's always the case that from a supervisory perspective, it's the bank that does have the license, and therefore the bank is always the outsourcer, and the fintech, the partner, is always the outsourcee, even though the economic substance may be a little different. As we've seen just before, the client may be completely unaware of the internal relationship between the two. Now, how does that look from a legal perspective? Then there are obviously risks with all of this outsourcing going on, and therefore supervisors and regulators worldwide are setting limits to how far you can go. So you cannot completely outsource with a banking license everything that you have to other firms. The principle of outsourcing has its legal limits, and they are, formulated in one way or another around the globe. We use here the EBA guidelines from most recent version is from 2019 as an example, but it would work very similarly in other countries as well. So the starting point is that outsourcing is normally part of your bank's risk management. So there's no notification obligation, at least in most countries. You don't have to notify the supervisor that you are outsourcing part of your function. It's your own responsibility as a bank. It's your risk management obligation. And a number of other steps apply when the outsourcing is deemed material. And it's important to know that what is material is also within the discretion of the bank. So this is all very much driven from an independent assessment done and carried out by the bank itself. Obviously, the bank is not allowed to outsource any key managerial responsibility, and the bank is required to carry out an appropriate due diligence. So when it partners up with a fintech, it needs to carry out a due diligence whether the fintech is appropriate and suitable. There needs to be a written outsourcing agreement, and importantly, the supervisor can monitor the outsourcee, can check what they are doing, and have access to premises, can have examination and information powers. But importantly, the supervisor doesn't have any direct way of inspecting and instructing the fintech. So the supervisor has direct oversight of the bank only and not of the fintech. That's how the legal regime works. And the question here that's already been appearing is whether you believe that the outsourcing regime by these EBA guidelines is adequate for purpose of regulating these partnerships. Maybe you take a moment to respond. Okay, now I already see the poll is closed to voting, so there seems to be a 2/3 majority of no. That is now the segue for the second part of the talk, and I hand over to Luca. Should I conclude with that? Sorry, I think I missed one slide. Okay, yeah, that was simply the point that I was trying to make earlier. Sorry, yeah, I should expand this. This was already the point I just made a moment ago. The upshot of the supervisory regime is that the outsourcee, so the fintech firm, is typically not directly supervised by the market supervisor. The outsourcee, the fintech, may frequently be a payment services firm, but maybe also something completely different. And even if it's payment services provider, then that's a very different type of license than a full banking license. The supervisor has information acquisition powers, or so can require the fintech to provide information, as I said a moment ago, but doesn't really have direct oversight of the fintech and doesn't have any intervention or sanctioning powers, which somehow lies in the logic of what I've just explained, right? So there is a direct oversight of the bank only, and the bank, in its own responsibility, outsources some of its obligations to the fintech. Okay, that was my concluding point, and now I hand over.
Now you should hear me, and next we move on to ask what basically we asked you a moment ago, and we got the response we wanted, at least 2-1, which is that perhaps this framework, as outlined by the EBA, is not so fit to deal with the issues of regulating the partnership between incumbent banks and fintech startups. Why is that? Well, maybe because, as the previous slides also outlined, there may be supervisory gaps. There might be a situation in which the fintech does something wrong against the rules, and it is on the incumbent banks actually to react to that and to do something about it. Of course, the supervisor, as we have seen, if its critical function has direct inspection powers vis-a-vis the fintech, but it doesn't have direct intervention powers. It can only make pressure on the incumbent bank to react, and the strongest form of reaction is, of course, severing the link with the fintech. There may be softer ones, but the ultimate reaction may be quite inflexible, and it can be untimely. So, and in addition to that, there might be a disalignment of incentives to some degree. So the bank may delay or obscure detection of the wrongdoing. It might be a problem with how the bank itself is organized. It is very common for large banks to have departments or subsidiaries which specialize in the interaction with the fintechs, and of course there could be a disalignment of interest between the bank as a whole and these departments or subsidiaries, which may to some degree be more inclined to a more relaxed, let's call it, relationship with the fintech. And in addition to that, there might be specific issues with front-end banks. Front-end banks are banks only in name. These are fintech startups that use other banks' licenses to provide banking services to clients who may be totally unaware that they are transacting with a bank, and this may raise consumer protection concerns. There's a question mark there. Like we put a question mark on the question of whether there might be macro prudential risks. The most intuitive kind of macro prudential risk is when the software as a service relationship is not with a startup, but perhaps with a large fintech or tech company, which may have quite a lot of contractual bargaining power with the bank, and therefore may be difficult to contain if there are problems. And also it may have relationship with a multitude of banks, perhaps all banks. Think of cloud computing services, and disruption at the big tech may lead to disruption for banking services actually throughout the globe. So a way to look at this relationship between fintech and startup is in fact a kind of contracting out of supervisory functions through technology and through the outsourcing contract. So in a way, the fintech manages to provide banking services to some degree, thanks to its relationship with the bank and the enabling technology, but itself will not be subject to the supervisory powers of the regulator of the banking authorities. So our next question then in our work is whether something can and should be done to basically either nudge or force these fintech players into the supervisory perimeter. And so here you will see three questions in a row about our previous slide, actually, which is on whether there are concerns that we should consider as serious. First of all, with regard to consumer protection, and I see that consistent with our intuition that participants in this seminar do believe that there are concerns when it comes to consumer protection. This is very interesting. And then you may wonder whether this raises concerns as regards banks' safety and soundness. The most intuitive reason why this may be the case is with respect to reputational risk, operational risk. And so can we do something to nudge these players back into the regulatory perimeter? Our answer is that something should be done. And the final question is whether there are macro-prudential concerns, whether there are risks for the financial system as a whole. And so there are various ways you can try at least to nudge these players back into the supervisory perimeter. One is the regulatory sandbox. One is the fintech license, which some jurisdictions have tried out. We propose a third one, which would not be an alternative, but rather a complement to this, which is the mentorship regime. But before I get to that, a few words on why the regulatory sandbox may not be the solution to achieve this goal. Regulatory sandbox have a different, they may be useful, but they have a different purpose, which makes them less fit for purpose, we think, consistently, so far as I can see, with attendance view. Their main purpose is to promote innovation and competition, to attract fintechs, but they have, these programs usually have limited resources. They accept a very limited number of firms for a limited time, and sometimes in some jurisdictions at least they are quite symbolic gestures, so to speak, more window dressing than anything else. In addition to that, in the sandbox space, some risks may go unexplored. You are not really live, and therefore you may not experiment with your products as though you were in the real markets. And so what we propose is this mentorship regime, which is an optional regime in which a bank would have the power to extend its regulatory license in all of it or parts of it to a fintech startup. And of course, it would do so not because it is a good Samaritan, but because in exchange for some equity, a fee, an exclusivity agreement, and so on. And it would only have to communicate to the regulator that the license has been extended. Once in, the fintech would be a fully regulated and supervised license firm according to the license that it gets. The consequence would be that the fintech would be subject to full regulation and supervision. And in our setting, the idea would be that the risk management, the internal control, and the compliance function would be the task of the licensing incumbent bank. So there would be outsourcing again, but of internal control functions and compliance, which would mean that the incumbent bank would be responsible and liable for what the fintech does, which ex ante should lead it to be selective in who it allows in. And the advantages of this regime would be, if adopted, of course, which is a big if, I anticipate that, if adopted, then it would clarify responsibilities, that it would be clear that there is an entity there which provides services that will be subject to supervision, etc. And therefore the fintech will be within the regulatory perimeter, but with a role also for the incumbent. The intermediation of the incumbent would definitely reduce the cost of becoming ready to be a full-blown financial intermediary licensed entity. There would be a facilitation in the communication with the supervisor. There would be a spillover of licensed entities culture vis-a-vis the fintech, and of course the vetting process would be ensured by the fact that the fintech would be still liable. So to conclude, there are a number of strategic partnerships between fintech and banks, and these should be looked at with a positive eye, because they increase innovation in banking, which is certainly useful. And the idea that we promote is that with the mentorship regime, we can find synergies between incumbent and fintechs also when it comes to the regulatory side, and therefore with a lower risk of having basically a shadow entity, a shadow financial institution doing something outside the system, which may create problems for the regulated space as well. And the way to ensure that this is not abused is by having the bank responsible and liable for what goes on at the fintech. I'm sorry I missed the left part of the screen while I was talking. So maybe later, if Jan can put on some of the answers again, we can discuss them. In the meantime, I thank you for your attention, and I just add that your comments will be most welcome if you have them, because this is again a work in progress. Thank you.
Thank you so much, George and Luca. The floor goes now to Anna Maria, who I think has a few slides that we will upload on the platform. I invite everyone, of course, to start thinking about their questions that they can submit in a few minutes on our platform. Anna Maria, the floor is yours.
Thank you. Do you hear me without a problem? Okay. Good afternoon, everyone. Thank you, Georg and Luca, for your outstanding presentation. I enjoyed it a lot. And thank you, Pierre and Jan and the whole school, Florence School of Banking and Finance, for organizing this online event. I'm delighted to have an opportunity to come and present now some of my thoughts. My short presentation will consist of 3 parts. In the first part, I will briefly summarize the key takeaways from Georg's and Luca's presentation. In the second part, I will support the arguments regarding the microprudential and macroprudential risks also arising from collaboration arrangements between banks and fintechs by linking them to some research findings of my own qualitative research on fintech regulation. And in the third part of the short commentary, I will share some critical comments about the new mentorship regime as proposed by Georg and Luca, and hoping to open the floor for the Q&A session. To start with, here we are. A quick summary of the key points Georg and Luca make. First, they describe the regulatory issues in regards to enforcement and effective supervision arising from fintech, banks, contractual collaborations, so-called partnership agreements, in which some of the functions of established financial institutions are outsourced to fintechs. Georg and Luca mentioned sandboxes as one of the attempts to address the problem, but also explain why they might not be really effective. This is because they do not aim primarily to guide startups to transition into regulated entities, but rather their aim is to foster innovation and promote competition. Georg and Luca also say that regulatory sandboxes are selective, so not all startups can participate in the program, and also regulatory sandboxes have short fixed term of duration, so it might also be not sufficient for fintechs to fully adapt to the new regimes. Second, Georg and Luca gave us the reasons and explained why fintechs collaborating with banks need supervision, so why the new regulatory regime is needed. They presented micro and macroprudential risks arising from such corporations, and I will come back to this point later in my presentation. And the third, the presentation of Georg and Luca proposed the new mentorship regime as a complementary tool to the regulatory sandboxes. This fintech mentorship program would make the regulatory license one of the components of the partnership agreements between incumbents and fintechs in exchange for equity stake, exclusivity agreement, and similar. That the decision that fintech is ready to be covered by the regulatory licenses of the incumbents shall fall solely in its own discretion, and regulators should just accept it without a delay. And in the proposed regime, fintechs would be able to outsource compliance and internal control to the incumbents, what would make the established institution responsible for any fintech violations. As for their own, what could incentivize them to decide carefully? Now, I would like to focus a bit on the second part of the summary, so on the analysis Luca and Georg presented in regards to the risks arising from contractual cooperation arrangements between banks and fintechs. I would like to add here a few quotes, as we don't have much time for anything else. From the interviews I conducted within the fintech industry in the years 2016-2019, which are part of my PhD project on fintech regulation. This is an ethnographic fintech study, which means that I was a part of the environment I was investigating, and my goal was to get the information at its source, not to rely on the things that were available online and also told regulators and told by fintech companies. The quotes you could see now, I chose for the purposes of the seminar, are coming from the interviews with fintech employees who have worked in fintech companies which have outsourcing agreements with banks. As you can read now, fintechs despite having outsourcing agreements with banks and as such possibly being subjects of supervisory inspections, are potentially really lacking supervision. If I would take what I was told in the interviews, I would say that there might be a significant misbehavior within the sector going on, and I did not expect to find out things that I was told. And as the fintech industry is constantly growing and fintechs are more cooperating, they're actually competing with banks, then both micro but also macro prudential risks are very much there, and they have to be addressed promptly. And now a few remarks on the mentorship regime as proposed by Luca and Georg. As much as I share the criticism to our regulatory sandboxes, saying that the period of time is too short and highly selective, I would also like to highlight a couple of issues in the proposed complementary mentorship regime that I see quite dubious and questionable, and I hope then that by questioning some things, I might open the floor for discussions later. First, I fully agree that we do need to establish a new supervisory regime for fintechs, and that such supervision has to be effective to protect the market stability and to limit systemic risk. However, having that in mind, I find some features of this mentorship a little problematic. It might be, I might not be right, but I see the possible applicability of this mentorship regime only to the fintech companies at their initial phase of the growth. So I assume we do not talk here about mid-sized fintechs, which are already on the market for more than a year for some time. Their business models seem to be working and attracting investors, as well as banks that want to cooperate with them. So this is, in my view, that these companies should be taken under the supervisory umbrella first, before the freshly established companies, which, as I see the program working, would become supervised before the medium-sized fintechs as a result of the fintech mentorship program. I see it in that way because mid-sized companies, which already survived some time on the market, in order to be successful, especially in the funding rounds, need to have compliance and risk management functions in place. So I wonder why would they be interested in mentorship programs, as that would come with some kind of exclusivity limitations, equity, which you mentioned, what could significantly slow down or even hamper growth of these fintech companies, not offering them, as I see it, on the other hand, a lot. Also because I think that for these kind of companies, being licensed is definitely not the most desirable thing. Most importantly, however, if we think about freshly launched fintech startups, I wonder why banks or established institutions that have banking license would be interested to participate in a setting in which they would have to perform again some compliance and management functions for, as I see it, small fintechs in their initial startup phase. And those companies often do not have processes in place, are just developing, improving technology and solutions. They don't have anything like, they don't have clear internal organizational structures. Their employees are fluctuating a lot. So the performance of these functions might be for structured, established institutions, banks, let's say, much more difficult and problematic that we would ideally expect. And that might surpass potential gains or profits arising from such a mentorship. And another comment, also, banks are very hierarchical, they're resistant to changes. So when we think about the established banks, I would say it might be just difficult to perform for them, contrasted with completely chaotic startup companies. And my another comment is that I find quite dangerous the further delegation of some of the public supervisory and regulatory powers into the hands of the private incumbents, because if the public, protected by regulators and supervisors, could fully trust that licensed and supervised banks don't misbehave, there would be probably no need for setting and checking the special conditions for banks or financial institutions to get the license, as we have them now, because they could just we could just allow them to decide freely when and if they want to get a license. And now I wonder what would happen if we would allow banks to mentorship fintechs, and as a result, we would let them decide if a fintech is ready to become a part of a relevant license. And at the same time, we say that the regulator cannot refuse nor delay the authorization, because this is the case. I would expect that we might end up with quite disorder in the financial sector, and some banks would probably push for some fintechs for regulatory supervision earlier. Others might, for some other reasons, delay the processes. And most importantly, in my view, the fintech mentorship program, if working well, I worry that it could significantly overstretch the scope of supervision aimed for traditionally licensed entities, making supervision at the end inefficient and leaving mid-sized fintechs, as I mentioned earlier, so the companies that are not in the initial phase and not the big ones that are always targeted by regulators and supervisors, outside of the radars, because of a huge growth in still small fintechs, which will have to be supervised now. These are just my general thoughts, and I just want to say again that I really enjoyed the presentation and the paper. I had also a pleasure to read, and I believe that we can and we should all take a lot from the ideas presented by Georg and Luca in building a new and, as we agreed in the pool also earlier, much needed supervisory regime for fintech, targeting both sides of outsourcing arrangements. With these words, I hope to open the floor for our Q&A part.
Thank you.
And thank you.
Thank you so much, Anna Maria. There is a poll going on still, so I invite all our participants to have a look, and it's asking about who would actually profit the most from the proposed mentorship regime. And meanwhile, I can see also that Jan is sharing the poll results. So while we give a bit of time to our participants to think about their questions, would you like, Georg and Luca, I know it can be overwhelming because there were several polls today, would you engage with one or two of the results which puzzled you most and which surprised you? And then we will engage with questions which are coming in.
Well, I can just say one word on this very last poll, which is still ongoing, which is very interesting because it seems to be an almost equal distribution here. That is actually a very good sign that people seem to be convinced that there is something in it for everybody, and this somehow already responds to some of the points that Anna raised, right? What's in it for the different participants? And of course, it's a big question. Just one sentence on this. Of course, the main benefit of our regime, I think, would be that's an optional regime, right? So it wouldn't force anybody, right? Only if it's attractive to people, they would be using it. And I think
okay, so let's start with the Q&A. We have a question by Alfio Puglisi, who is saying, I have one comment and one question. Let me try and find it again. My comment is that sandbox regime is an example of mentorship program due to the fact that regulators help companies to build compliance. That's already a key component of mentorship, meaning someone who, someone from the fintech industry, I get, will the mentorship regime be at the EU level? How can you ensure all the regulators cooperate? So I think there are two dimensions to the question. Who would like to address this one? Georg, Luca?
Luca, do you?
Luca, we don't hear you.
Yeah.
Oh, you need to unmute yourself.
Now you're back. Yeah.
So, yeah, in all frankness, we haven't gone into the institutional details yet, and therefore, intuitively, this could be a EU level regime, and the cooperation among regulators would be the same. we see now already regulatory arbitrage going on at the EU level thanks to technology. We didn't mention it during the presentation, but there are Solaris Bank is letting non-EU banks in through its APIs. So there are Turkish online banks that are selling their banking services within the EU thanks to Solaris license without being regulated within the EU. So I don't think that our regime would make things so terribly more dangerous than they already are, and possibly less, because there would be visibility on these entities. Yeah.
Thank you. So I think there are a few questions on the size of fintech, whether that matters for regulatory oversight. There is also a question, if you'd like to engage with that, we can do it now, Georg.
Sure. So this is a point that Anna also mentioned, right? What about mid-sized fintechs? And obviously the plan is somehow designed for the small ones that don't have the capabilities nor the manpower to go through the regulatory jungle of applying for a fintech, for a full license, essentially. But again, right, it may in some situations also be attractive to larger ones. So I would again leave this to the market to decide, right? I mean, the main purpose is ultimately to design, giving a helping hand to the very small and new ones. But if larger fintechs find it attractive, then I don't see any reason why it shouldn't. And by the way, somebody asked the question, what's the definition of a fintech and how would you limit it? I wouldn't, right? I mean, we typically gear it towards fintech, but again, there is no reason why it shouldn't apply to a larger set of firms that could benefit from that regime as well. Did you want to add anything?
So there was a question by Anand Shrivas was saying, what is the liability of banks in case fintech fail in mentorship regime and vice versa? Who would like to get a go at this one?
Well, basically, the liability would be the same as though the supervisor found compliance failure of the bank itself. So the bank, the incumbent bank, would be liable for again deficiencies in the compliance function that it has set up to make sure that the fintech complies. It wouldn't, as I view it at least, it wouldn't be directly liable for the violations, but rather liable because its compliance system may not have been effective. Again, not direct responsibility for violations, but direct responsibility for inadequate compliance and internal control system vis-a-vis the activity of the fintech. That would be my response.
I think there is a follow-up question on the difference between what you suggest in terms of mentorship and outsourcing by Thomas Tsesopoulos. Could you engage with this?
What is the difference is that the outsourcee would be a full-blown licensed entity. That it would be the main difference. And also, when we talk about outsourcing, we are talking about the bank letting the fintech basically market banking services, whereas here there would be an additional layer of outsourcing going in the direction, in the opposite direction, that is the fintech would outsource compliance functions to the bank. So it's not the same, and especially as regards the responsibility, the the fintech would be subject to all the powers of intervention power, sanctioning power of the of a bank, on a bank.
Sure. And can I just add one sentence that the fintech in our plan would be a fully licensed entity, right? So it would enjoy all the possibilities that a bank can do, and that is very different to the contractual regime that we have at the moment, or technology-driven system, where the fintechs are typically bound by the contractual terms of the outsourcing agreement. So that would be a major.
Thanks. I think part of the discussion is clearly also the matching process between both sides, on the fintech and on the banking side. And so Harry Trulias comes up with a suggestion and asks, could it be feasible that a pan-European fintech database list of companies that meet eligibility criteria set by the regulator is established, from which then the banks will be able to outsource services or activities? What do you think about this?
Sure, I think it's a good idea to have a database of all fintechs, but in my experience, these things typically happen on a more decentralized level, that these firms have common interest or meet somewhere at events, and you need to take a lot of things into consideration, whether you can actually be able and imagine to work with another firm, whether the chemistry is good between you, whether the portfolio that you have is adequate. So I find it rather difficult to imagine that you go through a list of fintechs and then say, okay, that one might be the one that we can work with. But definitely it can be a supporting feature, right? I think it wouldn't be the only source of inspiration, but it could be one additional tool that could complement.
Okay. So we'll make sure that we also, Georg, Luca, we send you sort of the comprehensive feedback, so that for your paper you have a look at all questions and comments. In the sake of time, so I think we'll extend by 2-3 minutes if you agree. I'd like first to give you a chance to pick a question which you want to answer, and then we'll give a chance to all of you to come up with your closing remarks. So who wants to start? If there is something, a question in particular that you'd like to engage with, feel free to start, Georg or Luca for that matter.
Yeah, so one question that comes up again and again, and that was also partly raised by Anna, is the question of what is the benefit for the different players. And I guess the key benefit would be for the fintech, in my perspective. So the fintech may profit tremendously from this regime because it's on a much more legally certain environment. It has much broader possibilities of expanding and using these powers. It is subject to a full license instead of being at the mercy of a bank right now. And what is in it for the bank is the other big question. And why would the bank be subject themselves to this? Well, one thing is that for them it may be more attractive if the bank is fully supervised as well, and it's not its own responsibility to supervise the fintech as it does at the moment. And secondly, the consideration, so the fee, will typically reflect the benefits that the regime has for the fintech. And finally, for the supervisor, I think the supervisor should also feel much more comfortable with having direct access to the fintech than this complicated way that we have at the moment. So I seriously hope that it is a win-win.
Yep. Thank you. Luca, and then Anna Maria.
Yeah, only to add on the question of who might be interested among the incumbents. I think that neobanks may find this an interesting area themselves. That is, they, like Solaris provides services to fintech of other kinds. They could also, they or someone else may also put to good use the regulatory know-how and compliance functions that they use for their own business and sell it to the fintech who may enter the mentorship regime.
Thank you.
I would just like to add that it's good, and I did not stretch enough that actually the regime is not mandatory regime, the regime you propose. So if we would we ask if it would be profitable for somewhere or not, but at the end the entities may decide what they want to do if they have an option to do it, and no one is forced to do anything. So in this sense, it's a very nice step forward the regulation of fintech.
Very good. Thanks to everyone. I would give the last words really to Georg and Luca for your final remarks. I hope that also the comments will help you in the next steps of your paper. So if you have anything you would like to share with us, please do so.
Yeah, these were all great comments. I was surprised there was no question on the coronavirus, but other than that, I think we've been very fortunate to have very savvy people and experts here.
Yes, thank you so much. Really, it would be great to receive all the Q&A, and also if you have further comments, we would be happy to receive them and to answer questions that we haven't been able to answer during this session. There are some that I see that are very interesting, and I would love to engage with them. Thank you.
Very good. Thanks a lot. Let me remind everyone that on Friday we'll have, speaking about the coronavirus, we'll have our next online seminar on the new state aid temporary regime. Feel free to sign up. I look forward to meeting you again soon. On the platform, online, physically, that would be even better. And stay safe and have a good afternoon. Thank you.
Thank you.
Thank you.
Thank you.